If you look at some price charts, you will see that the markets do three things. They move higher, they move sideways, and they move lower. When the markets are trending higher or lower, the important thing to notice is that they don't move in a straight line. They bounce between high points and low points whilst following the current trend direction. This lesson aims to show you a particularly useful trading strategy, how to trade the pullbacks between these high and low points. The strategy consists of 5 basic stages. Initially, we want to identify the general trend. Then, we identify the start of a pullback from this trend. Once the pullback begins, we simply wait for it to end. Then, using an indicator, we confirm that the pullback is indeed over. Finally, we open our position with the relevant stop loss and take profit levels set. For simplicity, when trading this strategy, we only require the MACD and stochastic indicators. Here we have examples of the MACD and stochastic indicators. The MACD indicator at the top of the screen consists of two elements: a slow-moving average represented by the dotted line and a fast-moving average represented by the histogram bars. The stochastic indicator at the bottom of the screen also consists of two elements: a slow line shown here in blue and a signal line shown in red. As you can see, the stochastic display is split into 3 sections. When the lines are in the top section, it means that the market is in an overbought condition, and when the lines are in the bottom section, it means that the market is in an oversold condition. If the lines are in the middle section, then it simply means that the market is ranging. Most people use the stochastic indicator incorrectly, as they assume the market is ready to reverse when the lines reach the overbought or oversold regions. However, this can occur long before the actual reversal. The correct way to pinpoint a reversal is to wait until both lines move out of the overbought or oversold regions and back into the middle region. Before we continue, we need to briefly explain some terms. We define a trend as being an uptrend if the fast-moving average of the MACD, represented by the histogram, is above the zero line and there is no bearish divergence with price. This means that each new high on the price chart is confirmed by each new bar of the MACD histogram. We define a trend as being a downtrend if the fast-moving average of the MACD is below the zero line and there is no bullish divergence with price. This means that each new low on the price chart is confirmed by each new bar of the MACD histogram. Here you can see examples of an uptrend and a downtrend. Notice how changes in price are being confirmed by the MACD histograms. The start of a downward pullback will be when a new high on the daily price chart diverges with the latest bar of the MACD histogram. For confirmation, a bearish divergence should also be clearly visible on a 4-hour chart. In addition, there must be a general uptrend and the MACD must be above the zero line. The start of the upward pullback, marked by the end of the downward pullback, is when the stochastic has been in the oversold region and has re-entered the middle region. There must also be a general uptrend, and the MACD must be above the zero line. Here you can see the bearish divergence clearly visible on both the daily and the 4-hour charts. We have now covered the basic elements of the strategy, so let's move on to an example trade so you can see it in action. Today is April 20th, 2007, and when we open our daily chart to identify the general trend, we see the current situation. If we draw trend lines, we notice that the trend is not only upward, it is actually becoming stronger. Let's consider the area that was indicated by the third trend line on the previous slide, as this is the area that we are actually interested in. If you look at the area within the red rectangle, you can see that every bar during the past 3 days is higher than the previous one. The MACD confirms this fact, but there is no bearish divergence. As you can see, in this case we need to wait until the next day to see what happens. The next day opened and closed within a small trading range. Furthermore, the histogram bar of the MACD, which corresponds to this price bar, has a lower value than the previous one. This is a good indication of an impending pullback. In addition, the stochastic is moving out of the overbought zone. Everything is looking good, but we still need to move to a shorter time frame. The 240-minute chart will do fine, and confirm our suspicions using indicators. The 240-minute or 4-hour chart clearly shows us the start of the downward pullback. Now we need to be patient and wait for the end of the pullback to find the entry point for our position. On April 23rd, the stochastic indicator enters the oversold zone, indicating that the downward pullback is almost over. However, as you will recall, just entering the oversold zone is not sufficient. We must wait for it to move back into the middle region. Later on the 23rd, the stochastic moves back out of the oversold region and returns to the middle region. This is a clear signal that the downward pullback is over and that we can open a long position at the close of that 4-hour bar. It is now time to open our position and place stop loss and take profit orders. As mentioned in the previous slide, we would go long at the close of the current bar. This bar closes at 1.3578, and that is where we open a market order. As a rule, the take profit order can be placed 2 pips below the previous high, in this case 1.3636, meaning that our take profit order will be placed at 1.3634. Stop loss orders should generally be placed 5 pips below the previous low or support level. The previous low in our case was 1.3525, meaning that we should place our stop loss at 1.3520. On April 24th, the price reaches our take profit level, and the position is closed with a 54 pip profit. In this instance, the profit achieved is not huge, but serves as a good example of how to implement the strategy. The usual profit achieved with this method is between 20 and 400 pips.